Global maritime trade is literally the lifeblood of the world economy. Around 80% of all the goods we trade, from oil and iron ore to cars and clothing, move by sea. Every day, huge ships connect producers and consumers across continents. In this episode of Beyond the Charts, we're unpacking how this massive system works and how it's changing, based on insights from the United Nations Conference on Trade and Development, or the UNCTAD, which is the Review of Maritime Transport 2025. We'll take a look at what's driving the global shipping today, from shifting trade routes and new technologies to growing pressures of geopolitics and climate goals. And we'll also take a look at what all of this means for the future of our trade. Let's start with the big picture. Now, after the pandemic shock, maritime trade has bounced back, but not quite the way it used to. In 2024, global seaborne trade reached about 12.7 billion tons, which is up by 2.2% from the year before. That's slightly above the average growth of the past decade, but well below the boom years of the early 2000s. In other words, shipping has recovered, but the long-term trend points to slower, more uneven growth. UNCTAD expects trade to rise by just 0.5% in 2025, which is essentially flat. Now, why the slowdown? See, global trade faces a tricky mix of headwinds like weak demand, persistent inflation, and tighter financial conditions. Even the WTO projects that overall merchandise trade will grow barely at about 0.1% this year. Now, beyond short-term shocks, there's a deeper story to this. The link between global trade and GDP is weakening, whereas economies are growing, but each unit of GDP now generates less cross-border trade than ever before. That's why shipping volumes aren't surging even as recoveries take hold. And yet, volatility remains the defining feature. Now think about it. Trade collapsed in 2020, rode back in 2021, slowed again with the Ukraine war, energy crisis, and inflation around 2022 and 2023. And this was disrupted once more by the Red Sea crisis. These start-stop cycles make life hard for shippers and ports, which swing between capacity crunches and quiet docks. Here's a fascinating detail from the UNCTAD report. In 2024, while total trade volume rose 2.2%, shipping output in ton miles jumped nearly 6%. That means ships were sailing farther on average. This is a direct effect of longer detours and rerouted trade. So even modest growth in trade can mean much higher demand for shipping if supply chains stretch out. But if routes shorten again, the same ships could suddenly be in excess supply. For now, these longer voyages are keeping ships busier and freight revenues higher. The question here is, what happens when the world's sea lanes normalize? Not since the Suez Canal crisis of the 1960s has the geography of global shipping been this disrupted. Now, geopolitical tensions and climate shocks are literally redrawing the world's sea routes, which is forcing ships to take longer and costlier detours. Now, take the Red Sea. It is one of the most important arteries of global trade, which links Asia and Europe through the Suez Canal. But since late 2023, escalating conflict around this region has made it too risky for many vessels to even pass through. By May 2025, traffic through the Suez Canal had dropped almost 70% from 2023 levels, because of which ships began sailing thousands of extra miles around Africa's southern tip, which is the Cape of Good Hope. Now, on the other hand, the Panama Canal has also faced its own crisis. Not from a war though, but from climate. A historic drought lowered water levels and forced authorities to restrict the number of ships passing through in 2024. Now, between the Red Sea and Panama disruptions, vessels were suddenly traveling much longer routes, which caused massive delays and driving up costs. The numbers tell the story. While total trade volume in 2024 just grew about 2.2%, the total shipping output in ton miles jumped nearly 6%. Container ships saw an even sharper rise, which was up almost 19%. In short, the same cargo now needed more ships and more sailing time to move. That kept freight markets tight even without a surge in trade volumes. But there's a trade-off here. Longer voyages just mean higher fuel and insurance costs, and even more emissions with slower deliveries. According to the UNCTAD, global shipping emissions rose by about 5% in 2024. Now, that was partly because of these extended detours. Meanwhile, tensions around the Strait of Hormuz, which handles over 11% of the world's maritime trade and over a third of all the seaborne oil, continue to keep the world on edge. Now, the flare up between Iran and Israel in mid 2025 sent tanker freight rates soaring due to rising war risk premiums. Even trade policy is reshaping shipping lanes. In 2025, the US introduced new tariffs and proposed port fees on certain foreign built or operated vessels. Now, these measures are still evolving, but they could change how global fleets are deployed and which ports they frequent. All of this is driving a deeper shift in how supply chains are organized. Companies are diversifying production and sourcing, moving away from over centralized models. Now, we're already seeing stronger export growth from Southeast Asia in countries like Vietnam, Thailand, and Indonesia, as well as from India and Mexico. Now, it's important to separate what's temporary from what's structural. Some of these detours, like the Red Sea reroutes, will probably end when security improves, but others may be here to stay. Climate driven water shortages, like those in Panama Canal, could become more frequent, and geopolitical rivalries aren't going anywhere. That means global shipping might have to stay permanently more flexible, adapting to an era of shifting trade corridors. The impact of all of this isn't shared equally, though. For businesses, longer routes mean higher logistics costs and more uncertainty. On the other hand, for policymakers, it highlights the need for secure trade corridors and better regional connectivity. And for consumers, it often translates into higher prices for imported goods. But the harshest impact here falls on developing countries, especially on small island and landlocked nations. As UNCTAD's forward puts it, and I quote, small island developing states watch their import bills soar while their export competitiveness erodes. Now, landlocked developing countries sometimes pay transport costs which are three times more than the global average, and this gap widens with each disruption. In other words, the great rerouting of global trade isn't just a story about ships and canals, but it's also a story about how distance, politics, and climate are reshaping the cost of being connected to the world. Now, if you have ever seen those giant ships stacked high with colorful containers, you've seen the workhorses of global trade. Now, container shipping keeps the world's supply chains running, moving everything from electronics to furniture to clothing in standardized steel boxes that make global trade possible. But after a wild few years, this sector is now in the middle of a reset, adapting to new trade routes, new partnerships, and a lot of uncertainty. Now, let's start with how trade routes themselves are changing. The big east west corridors connecting Asia with Europe and North America still dominate global container traffic. But growth is shifting elsewhere. South south trade routes like Asia and Africa, Asia and Latin America, and intra Asia were the most dynamic in 2024. As developing economies industrialize and trade more with one another, we're seeing more direct shipping links between these regions. Now, mind you, this isn't just about new markets, but it's also about resilience. See, shippers are deliberately diversifying routes and building more flexible supply chains to avoid dependence on any single choke point or trade lane. In other words, global trade is learning to hedge against shocks. Let's now look at the industry side of the story. After the pandemic, container lines made record profits as freight rates hit historic highs. From 2021 to 2022, they went through what UNCTAD calls a cash flow boom because these carriers used that windfall to order a wave of new and larger ships. Those vessels are now being delivered just as demand growth is slowing. In 2024, the total container shipping capacity jumped nearly 10%. Now, that's the biggest annual increase since 2008, which is also raising fears of too many ships chasing too little cargo. When that happens, freight rates usually fall, and rates have indeed been swinging wildly. The Red Sea crisis in early 2024 sent them soaring close to pandemic peaks, but by the end of the year, they had cooled, but they stayed well above the pre-crisis levels. Then, in first half of 2025, they spiked again, this time because exporters rushed to ship goods ahead of possible tariff changes and amid rising geopolitical risks. The report sums it up neatly, showing us how trade policy uncertainty, new domestic shipbuilding programs, and shifting alliances are making this one of the most volatile periods in container shipping history. Now, speaking of alliances, the industry map is being redrawn. The long-standing 2M alliance between Maersk and MSC ended in 2025. See, Maersk joined the Hapag-Lloyd to form the new Gemini Corporation, while one HMM, and Yang Ming created the Premier Alliance. Meanwhile, MSC, which is now the world's largest carrier, has decided to go solo. These new partnerships aim to match capacity with shifting trade flows, but they're also causing short term confusion for shippers about routes, schedules, and reliability. So, where does that even leave the industry? The container sector is coming down from the extreme highs of 2021 and 2022, and they're entering more of a balanced but also an uncertain phase. The fleet capacity is growing faster than the trade volumes. Routes are becoming more diverse. Alliances are reshaping. The UNCTAD expects containerized trade to keep expanding, though at a slower pace than fleet growth. For businesses, that could mean lower freight costs than in the boom years, but also more volatility as carriers adjust. The makeup of what the world ships by sea is changing, and nowhere is that more visible than in energy trade. For decades, bulk trade cargoes like oil and coal dominated maritime shipping. Today, decarbonization goals and geopolitics are reshaping those flows. Some changes are temporary, while others are structural. Now, let's start with coal. Despite the global shift toward cleaner energy, coal still remains a heavyweight in dry bulk shipping. In fact, 2024 saw a 3.3% jump in seaborne coal trade, reaching its highest level since 1980. Now, what can be the main reason for this? The answer is strong demand from Asia, especially from China and India, and also industrial stockpiling by several importers. But as the UNCTAD points out, this is a temporary rebound rather than a comeback. In the long run, coal share in maritime trade is flattering out, while the gas and cleaner fuels slowly gain ground. Now, the center of gravity has decisively moved eastward. European and North American imports are shrinking, and Asia now dominates both demand and trade routes. That means longer voyages. For instance, coal shipments from Colombia or Russia traveling farther to reach Asian ports. Yet, even with occasional demand spikes, the broader trend is very clear. We can expect a gradual decline in coal's role as climate policies tighten over the coming decade. Now, oil tells a similar story as well. There is a long term pressure from the energy transition, but short term turbulence from geopolitics. In 2024, seaborne crude oil shipments fell by 1.5% and refined petroleum products slipped by 0.7%, which is extending a pattern of stagnant growth seen since 2010. But interestingly, ton miles, which measure both cargo and distance, rose up by about 1.6% for crude and 6.5% for refined products. But why did this happen? Because the war in Ukraine and related sanctions have forced a massive reshuffling of routes. Europe has cut pipeline imports from Russia and is now buying oil from the US and the Middle East, while Russia sends its barrels east to Asia. So even though less oil is moving overall, ships are sailing much farther. Now, tanker markets stayed firm in 2024. Not at the wild peaks of about 2022 and 2023, but still profitable thanks to those longer hauls, and new players like Brazil and Guyana, which are emerging as exporters, driving even more long distance shipments to Asia. Then there's liquefied natural gas, or LNG, which is the most dynamic fossil fuel in maritime trade right now. This is often seen as a bridge fuel in the economy transition. See, LNG has become central to global energy security. In 2024, LNG trade volumes rose by about 1.1%, but ton miles surged a massive 12.2%. That means longer voyages from Africa and US to Asia and Europe, as new export terminals came online in both these regions. The UNCTAD expects this momentum to continue even in 2025 as more liquefaction capacity ramps up. Now, the LNG fleet is growing fast, with a record order book and new routes forming as the US joins Qatar and Australia among top exporters. And beyond these fuels, there's already a talk of hydrogen and ammonia as potential clean energy cargoes for the future. But for now, UNCTAD notes that they're more relevant as alternative ship fuels than as major traded commodities. Let's now look at critical minerals. For most of the 20th century, oil was the world's most strategic commodity. But in the 21st century, a new set of materials is taking that title of critical minerals. Now, these are the metals that power clean energy and high tech industries. Think about lithium, cobalt, nickel, copper, and more. They're what make electric vehicle batteries, wind turbines, solar panels, and smartphones possible. And as demand for all these products soars, seaborne trade in these minerals has surged, which is turning ships into the new arteries of the green economy. The report calls this one of the most defining shifts of our time. Asia, and especially China, has become the central destination for many of these minerals because that's where most of the processing and manufacturing happens. Meanwhile, Africa, Latin America, and Oceania are the main sources. Think copper from Chile and Peru, cobalt from DRC, bauxite from Guyana, and nickel ore from Indonesia, almost all flowing towards Asia. But here's the catch: production and trade are highly concentrated. The report notes that global trade in critical minerals remain concentrated in a handful of exporters, which makes supply chains vulnerable to both political and logistical shocks. Here's one striking example. In 2023, the DRC accounted for more than 80% of all seaborne cobalt exports. Now, that level of dependence mirrors the old reliance on a few oil producers decades ago. Now, naturally, this has set off a geopolitical scramble. Importing countries are racing to secure supply. The US Inflation Reduction Act and the EU Critical Raw Materials Act both aim to diversify sources and expand domestic processing. On the other side, resource rich countries are asserting more control, imposing export restrictions, as Indonesia has done for nickel, or adding local content rules to keep more value at home. For maritime trade, this means bigger cargo volumes and new routes. UNCTAD reports steady growth in seaborne shipments of bauxite, nickel ore, manganese ore, and copper concentrates, mostly carried out by bulk carriers. Strategically important lanes now link Africa, Latin America, and Australia with Asia's industrial centers, above all, China. If you trace copper and cobalt flows on the UNCTAD's maps, Asia clearly sits at the heart of its new network. Now, is this shift temporary? We really can't say so, as UNCTAD's projections show global demand for these energy transition minerals could nearly triple by 2030 and quadruple by 2040. That means decades of expansion in mining, processing, and crucially, shipping. While recycling and technology might ease the pressure later, the near term reality is clear. The ocean trade in critical minerals is entering a long term growth phase, and just like oil once did, now these minerals are already reshaping alliances, with countries forging new strategic partnerships around minerals to secure their place in the clean energy supply chain. Even as ships carry the materials needed for the world's green transition, the shipping industry itself faces one of the toughest challenges yet, which is decarbonization. Maritime transport is incredibly efficient for moving huge amounts of cargo, but because of its sheer scale, it's still a major emitter. Big ships burn fossil fuels, and the sector accounts for about 3% of all global emissions. The UNCTAD calls this the gap between ambition and reality, a gap the industry now has to close. And it's not getting easier. In 2024, shipping emissions rose by 5%, partly because vessels had to take longer routes and sail faster to meet delivery schedules. Meanwhile, more than 90% of the global fleet still runs on conventional fuels. Only 8% can actually run on clear alternatives. To change that, regulators are moving fast. In July 2023, member states of the International Maritime Organization adopted a climate strategy aiming for net zero emissions from shipping by around 2050, with interim goals for 2030. Then, in April 2025, the IMO's Environment Committee approved draft measures under a new net zero framework, which is a global system that combines technical and economic tools to drive change. Now, here's how it works. First, they need to have a fuel standard. Ships will need to reduce the greenhouse gas intensity of the fuel which they use over time. Second, there has to be a pricing mechanism. Ships that exceed emission targets will have to buy remedial units, contributing to a new net zero fund, while cleaner ships could earn rewards. That fund would then help in finance innovation, port infrastructure, and a just transition for developing countries. So, what does a low carbon future look like at sea? It won't be one single fuel or technology, but it's a mix. LNG is already being used as a transition fuel, making up to over one third of new ship orders in 2024. Methanol is gaining ground quickly, while ammonia and hydrogen are seen as the next generation of zero emission fuels, even though the technical and safety hurdles remain. At the same time, the efficiency improvements like better hull design, slow streaming, smarter routing, and even wind assist technologies are helping ships burn less fuel. The order book shows how fast the industry is pivoting. As of May 2025, more than half of all ships on order, about 53% by tonnage, are being built to run on alternative fuels. But this also creates a zero carbon fuel dilemma. Ships last about 20 to 30 years, and no one knows which future fuel, be it ammonia, hydrogen, or something else, will win. That uncertainty makes it challenging for ship owners to commit today. See, existing regulations are also tightening. Since 2023, measures like the Energy Efficiency Existing Ship Index, which is the EEXI, and the Carbon Intensity Indicator, which is the CII, have forced ships to meet efficiency benchmarks. Those that don't must either slow down or retrofit, both of which affect costs and capacity. And if the IMO's carbon pricing plan is approved, operating costs will raise further for high emission vessels, giving ship owners another reason to go green. But going green won't be cheap. UNCTAD estimates annual investment needs between $8 billion and $28 billion for new or retrofitted ships and an additional $30 to $90 billion a year for onshore infrastructure. See things like green fuel production, storage, and port refueling systems. Now, many older ships will be recycled, converted, or replaced in the coming decade as the fleet turns over. In short, the decarbonization of shipping is no longer a distant goal, but it's a massive industrial transformation which is already underway. And while the road to zero carbon seas will be long and costly, the direction is now set. Global shipping is finally starting to clean up the cargo that makes the world go round. Maritime trade isn't just about ships and cargo. It's also about ports and the people that keep this massive system running. The last few years have stress tested both, pushing ports to become smarter and more efficient, while also reminding the world just how vital human labor is to global trade. Ports are where sea meets land, and they've been under pressure. Even in 2024, the congestion was rising. UNCTAD data shows us that the average vessel waiting time increased from 5.2 to 6.4 hours in developed countries and from 10.2 to 10.9 hours in developing ones. Those few extra hours may not sound like much, but across thousands of ships, they ripple through the entire supply chain, adding costs and delays that businesses and consumers ultimately feel. To fix this, ports are going digital. Tools like Maritime single windows and port community systems are transforming how information flows, which is allowing ships, customs, and port authorities to exchange data electronically instead of relying on paper and siloed systems. This means faster cargo clearance, smoother vessel scheduling, and more predictable turnaround times. UNCTAD's data even shows that ports, including these systems, tend to score higher on logistics and trade facilitation indicators. Automation, from yard cranes to container tracking, is speeding things even further. But digitalization also brings in new risks. As ports become more connected, they also become more vulnerable to cyber attacks that can cripple operations. Then there's the human side of the story. Ports depend on people, and the workforce itself is evolving. There's also been a progress on gender diversity. In 2024, women held about 39% of management and administrative roles in reporting ports. But in hands on operational jobs like cargo handling, that figure drops to just 2%. Automation could help change that by making physically demanding roles more accessible, but it'll take active policy support to close that gap. At sea, the situation is even more urgent. The industry faces a growing seafarer shortage, which is worsened by tough conditions exposed during the pandemic. The report highlights that protecting seafarers' rights, fair treatment, shore leave, repatriation, and safe working conditions under the Maritime Labour Convention is essential to attract and retain skilled crews, because without them, global trade literally stops. As automation advances and autonomous ships edge closer to reality, the kinds of maritime jobs will change. Some traditional roles may disappear, but new roles in technology, data, and remote operations are surely going to emerge. Now, managing this transition fairly through training and upskilling is key to keeping the system both efficient and humane. Digitalization and human welfare now sit side by side as priorities. Smart ports using data, AI, and IoT are becoming the norm, enabling faster, cleaner, and more reliable trade flows. And international frameworks from the IMO's Facilitation Convention, which mandates digital port systems, to the WTO's Trade Facilitation Agreement, are pushing for universal adoption, especially in developing countries that risk being left behind. Now let's look ahead. Maritime trade has always been called a barometer of the global economy, sensitive to every breeze or storm. And right now, it's sailing through both short term turbulence and long term transformation. The challenge is knowing which is which. Structural shifts are the deep, lasting changes, which are a slower pace of global trade, new routes shaped by emerging markets, the reshaping of energy cargoes as the world goes green, the rise of critical minerals, and twin revolution of decarbonization and digitalization within shipping itself. These are the forces that will define maritime trade for decades to come. To stay ahead, shipping lines might focus on high growth routes like in Global South, which invest in dual fuel vessels, or build expertise on moving new cargoes like critical minerals. Meanwhile, cyclical forces like geopolitical uncertainty will keep testing the system. The trick here is to stay resilient enough to ride out those waves without losing sight of the horizon. A port might expand and digitalize, but it also needs contingency plans for sudden disruptions. A shipping company might enjoy a temporary freight spike, but if it rushes to order too many new vessels, it risks repeating an old mistake and being caught in the next downturn. Ultimately, maritime trade isn't just about ships or cargo, it's about connection. It reflects how economies rise, adapt, and endure through change. If the industry can stay steady through today's turbulence, it won't just weather the storm, but it'll also help steer global trade toward a more resilient and a sustainable future. That's it for this edition. Thank you for watching, and do let us know your feedback in the comments below.